We estimate that in order to achieve net zero emissions by 2050, at least $4 trillion will need to be invested in clean energy, technology, infrastructure, and distribution. Underpinning this capital investment then really needs to be strong government support through public sector funding, but more importantly, through the creation of a robust policy framework, which will in turn reduce project revenue risk, increase project viability, and drive private sector innovation and investment. These are all key prerequisites for debt finance providers coming into the space. In a number of jurisdictions, we have also seen governments introduce strong tax incentives, like the Inflation Reduction Act in the US that was passed earlier this year, which extends the existing government support on renewable energy developments to also include facilities that utilize less traditional technology, for example, like carbon capture or clean hydrogen production facilities.
I agree with Fern's comments regarding the need for strong government support to achieve net zero emissions. We have seen in the renewable energy sector the use of feed-in tariffs and quota schemes, as well as contracts for difference, all of which have helped drive growth in the wind and solar sectors. Whilst we urge governments to be bolder in incentivising the market and mandating change, governments need to ensure that any such support is proportionate and does not result in super profits for the recipients, particularly at the expense of the consumer. Many new green technologies have large upfront R&D costs and long and risky development periods before they may generate long-term returns. PE and infrastructure funds need to generate returns to their investors and are reluctant to make large, risky upfront investments in R&D for new technologies when there is such uncertainty around the technology. However, many governments have established national green investment banks, which need to be utilised more to support R&D in new technologies and plug that initial funding gap. PE and infra funds will be willing to subsequently invest when the technology risk has been minimised or removed. This is a key area where governments need to support the energy transition.
There is constant innovation in the energy sector. We have really seen this pick up in the last few years. From the debt perspective, the technology really needs to be proven. To the extent that these are still in the development stages, the market views it very much as equity risk. Once companies and sponsors are able to demonstrate that technology works and can support a robust and established revenue stream, can the debt providers move in?